And we get another soggy day on Wall Street, limping a little bit lower, but ultimately not really breaking down, frustrating those of us that are tilting bearish on this stock market after the Fed's announcement last week couldn't get the speculative juices flowing in a lasting way. And so today, while everything else is in grass is growing, paint is drying mode, we are going to focus our view on crude oil because here we have some more interesting developments here and the possibility that something of a time bomb is starting to quietly tick in the background. So what we're going to do here is get a little bit of a state of play on what exactly is going on and where prices have been, where they're going, what is perhaps the reason why they're here, and then try to see what could be the next move and establish for ourselves then how that might work out as a trade setup, perhaps at some point here in the relative near term, as we sort of stretch the bounds of credibility for what's been going on up to now. So here's a look at WTI. This is the West Texas Intermediate, a US-based benchmark for crude. And what we broadly find here is that the trend has been cautiously pointed higher basically since the beginning of the year. So we found a bottom right under 68 bucks a barrel right mid-December or so and revisited in that direction at the beginning of the year, didn't set a new low, and since then we've had this kind of slow creep higher where at this point with everybody kind of focused on stocks and AI hype and everything else, it's almost lost in the conversation that crude oil is up nearly 23% so far this year. And we're only 3 months into the year. And at just under 63 bucks a barrel here, so right around here where it's sort of oscillating, we're at the highest levels in about 5 months, going back to here, early November. So there is clearly a conversation here about this being one of the standout performers, not as explosive certainly as we've seen in equities or perhaps even in Bitcoin, but a nice quiet narrative that has really played out independently of anything that we've seen vis-a-vis the Fed, anything that we've seen vis-a-vis broader risk sentiment, a sort of quiet pocket of the market where little by little, we have very significant gains from the start of the year at this point, seemingly divorced from the broader macro narrative. There's a little bit of data that's going to hit us this week. We're going to get first the weekly numbers for crude inventories. And what we find here is that recently these numbers have been significantly more supportive than expectations. So we can see here the past 2 weeks, we've had significant declines, 1.5 million barrels, almost 2 million barrels against expectations for increases. This is obviously more supportive because when inventories come down, that means that there is a draw from those inventories, so ostensibly supply is being drawn down, and that should be a boost for the price on some level. We're expected to see another decline this time, down 1.3 almost million barrels to be reported this week. It's a similar story downstream when we get to refined products. And here's gasoline inventories, and we can see that they've been declining for a few weeks in a row now, 7, and we're expected to see the 8th consecutive week of drawdown here again. And we can see also this too has surprised in a more supportive direction. So we were looking for declines here of 2 million, 1.3 million, and instead got declines of 5.7 million, 3.3 million. So the pull from gasoline inventories, which then one might expect to have downstream effects on a pull from crude inventories, which then might have an effect on boosting prices to refill those stocks. All of that seemingly lines up, assuming it works out broadly in line with expectations or with this pattern of utilization overshooting, these drawdowns overshooting that we've seen over the past several weeks. All of it seems to line up to a tailwind for crude. However, if we look at the picture slightly broadly, if we back up a little bit and take a broader perspective of what's actually occurring here, there is a very significant disconnect. The U.S. is at this point producing more crude oil than it ever has in history. We are at 13.3 million barrels a day. That's more crude oil production than we've ever seen at any time. What we find is that as this is occurring, broadly speaking, crude oil is about anchored. So obviously there was a major decline during COVID. That much makes sense. As a matter of fact, what we saw then was a pullback that really brought us very, very dramatic reductions in price, in production. You can see that here, production falling off a cliff, the price falling off a cliff because the economy essentially got stopped on both counts. Since then, production has rebuilt and established a new record high. Crude oil has rebounded, not surprisingly, because economic activity was restarted. But this period most recently, call it 2023 onward, what we find is that even as supply increases, the price is kind of oscillating. It's kind of stuck here, which seems a bit counterintuitive because, of course, more supply, you'd think, means the price ought to be at least somewhat pressured lower. So let's put a question mark on that and keep looking at the dynamics of this market to see where maybe an answer is hidden. Not only are we at record high output, we seem to have gotten a lot more efficient at getting there. Notice what's happened since COVID. Here's the COVID recession right here. In the red is the number of fracking rigs that are operational. In the blue, the number of overall oil rigs. And do keep in mind that they're on separate scales here, so this is not actually above this in numerical terms. This is somewhere between 200 and 300 fracking operations, and this is somewhere between 300 and 600 rigs. So we can see here, more importantly, that as we've gone to record highs on output, again, here's the COVID drop. So after the COVID recession, here is the steady build in output. We've had a bit of a recovery in the number of both traditional and fracking rigs, but a significantly lower high than what was there before the pandemic. So not only are we producing a record amount of crude, we're doing it much more efficiently. We're essentially doing a lot more with less. We need far fewer, it seems, active rigs of either stripe to get to these record levels. Now, U.S. oil consumption averages about 20 million barrels a day, give or take. At 13 and a half almost million, we're producing almost everything that we're using, but it does leave a little bit of room for imports. Maybe there's a clue there. Well, as it turns out, imports have been basically flat since COVID, haven't really gone anywhere. Whereas exports are increasing at a relatively healthy clip. In fact, you can see until the shale revolution really gets us underway in 2014, the U.S. isn't much of an exporter at all. Imports have been steadily declining for years, but it's really with the spike blow up in shale, where fracking really gets off the ground, that we start to build and build and build and build and build more and more and more exports. And we can see the incline after a bit of a hiccup after COVID has been reasserted. So much so, as a matter of fact, that at this point, the gap, and this is a 4-week average, this is weekly data from EIA, the gap has been narrowed to a meager 2 million barrels a day that we're importing. Now, if we consider that it's taken us a much smaller number of operational rigs to get to record output, closing that gap seems not exactly like a tall order. Not only that, but spooling up production and then storing excess output that may not be consumed immediately, that seems to be something that is relatively easily set up when we consider how much capacity we're using. If we look at the major facilities here, we can see that at the highest level, we're looking at about capacity utilization of 60%. So looking at storage here, we could be storing a lot more. We could be filling up this storage to a greater extent, which means that if we really had to get to complete energy independence in the United States, which is still the biggest user of crude oil, then we could do it in relatively short order. It would not be the world's most dramatic adjustment. And so this once again raises the very important question, okay, well, if this is what's going on, why is it that crude oil is trending higher? If we have tons of supply, indeed record supply, so much so that we're exporting more and more without imports growing, if there's ample storage capacity and all we need to do is export a bit less and store a bit more to get to a point where domestically the U.S. could be completely energy independent and rely not at all on external sources. Obviously, there would be an adjustment. That adjustment would have a bit of a shock on the market, but these are not insurmountable gaps by any stretch of the imagination. Then the question becomes, well, okay, so what's going on here that crude oil is up since the beginning of the year? Supply and demand dynamics certainly don't seem to line up there. Perhaps this is OPEC. We constantly see headlines about OPEC cuts, output output. Maybe this is what's going on. Maybe there is a global imbalance that's echoing back into the US. Well, as it happens, when we look at OPEC's output, even when we look at the broader OPEC adjacent producers included in the mix, the so-called OPEC plus, that includes Russia, includes Brazil, most recently. Angola has actually left the grouping. But if we look at this, this does not look like OPEC is really doing much of anything. And of course, we've argued long and loud here on Macro Money for a long time that OPEC has been largely ineffective at enforcing its collective output targets because they can't get all the members to actually stop cheating. And so what happens most usually is if the price of oil is falling, people produce less because they're not in the business of selling cheaper oil. But it's the price that leads the production, not the production that leads the price. And indeed, we can see here, OPEC output has not really gone very much of anywhere in recent years. It continues to basically idle. Now, these are, of course, estimates, so keep that in mind. But nevertheless, what we're looking at here is not exactly a dramatic retrenchment on supply that would give us a global shortage and bid up the price at the same time that the US is only producing more with ample room to store. So it seems like, again, we're left scratching our heads as to why crude oil is doing what it's doing. Helpfully, the Energy Information Administration, that's part of the US Department of Energy, produces production and consumption estimates globally. So we can actually take it a step further still and find here that production is outstripping consumption by a meaningful margin. In fact, a margin that seems to be generally approaching kind of 85, 86 barrels, million barrels per day globally. So again, this is not seemingly a supply-demand story because there is more than enough supply for the amount of demand. And this includes not just crude, but overall liquid fuel consumption. So with all of that in mind, this still needs an explanation. Now, the obvious one that jumps out is geopolitical. We still have a war that's ongoing between Russia and Ukraine, where both sides have increasingly taken to attacking each other's energy infrastructure. Russia is shooting rockets at big pockets of Ukrainian storage. Ukraine is running suicide drone attacks at Russian infrastructure, both oil and gas. So there's certainly a level of scary headline flow there. On top of this, we, of course, have the conflict in the Middle East, where the terrorist group Hamas provoked a war with Israel. And now the Yemen-based Houthi rebel group, which is another Iran-backed group like Hamas, they are sympathetic to Hamas's cause, and they've taken to attacking the tankers that pass and other commercial vessels in fairness, that pass through the Red Sea on their way to the Suez Canal, which is, of course, how oil from the Persian Gulf gets into the Mediterranean and to Europe. So, again, seemingly, there is a reason to be concerned. Now, whether this has actually had any real impact on market dynamics is suspect, because if we look at this stage at the spread between the price of U.S. based crude, and as we've just argued, it's overwhelmingly such that the U.S. could be energy independent, produces a ton of the crude that it consumes, and so there really ought to be something of a discount for U.S. crude. A discount would be normal. And the spread between that and the more international Brent benchmark, which is angled around North Sea crude, and that would be where you might see a premium build up around these supply disruptions in the Middle East and Europe. But as it happens, since about 2013, the middle of 2013 onward, the gap between the prices here has been a fairly steady $5 premium on Brent relative to WTI, and it hasn't really gone anywhere. The bottom of the range is about a $12 gap, where Brent is about $12 more expensive. The top is about $3, where WTI is about $3 more expensive. The middle of the range is around $5, and we're sitting right there. So it doesn't look like all of these geopolitical disruptions are actually having any real effect. But that doesn't mean the markets can't build in a risk premium into prices on a speculative basis. And so what this becomes then is something of a time bomb, because it isn't economic reality, supply and demand, that seems to be accounting for crude oil being higher, even when we take the disruptive nature of geopolitics around the key production routes at the moment into account. It's that the markets fear there might be some sort of real world consequences on supply disruption eventually. And so invariably, if the markets are continuing to discount, and if those disruptions don't actually occur, the longer they don't occur, the more vulnerable this becomes to the flow of negative headlines eventually drying up. Needless to say, the Israel-Hamas war will end eventually. The Russia-Ukraine war will end eventually. We are then vulnerable inherently to any kind of a headline suggesting we're anywhere closer to that end on either front, separating us from what could be a significant decline in crude. Now, do we have any current signaling to suggest that is imminent? Arguably, no. But if we were to get underneath, give or take $80 a barrel here, this former resistance become support, we might guesstimate it as something about here. If we were to break through this on a closing basis, a trigger might well be immediately in front of us. If we were to take a slightly longer term view here and look at it perhaps as a bit more broad, then we could perhaps guesstimate something like this. here as a kind of supporting range between about 80 and 78. And if we were to get through that all the way down to here somewhere, then maybe there's a much larger reversal. But at this stage, we don't have that confirmation. What we have is a market that's seemingly looking to headlines for its support. And were those headlines to turn or even offer something of a tone shift, the whole thing might unravel. And that is macro money for today. As ever, we are here right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. Back on with Chris for Futures Power Hour on Fridays, though probably not this week since we have a market closure for the Good Friday holiday. I'm back on with Tom and Victor for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, @IlyasPivak. Thanks very much for joining. See you tomorrow.